Good afternoon, Jacksonville. It is JJ the Realtor, the Juggernaut of Jacksonville, and I'm here to teach you how to manage your money so your money works for you. We're going to talk about dividends, we're going to talk about high yield savings accounts, and certificates of deposits. Now, you might be asking, what are you even speaking about? And that's great because I'm here to educate you at no cost to you and only your benefit. First off, we have dividend stocks. Did you know when you purchase stocks, companies will pay you for buying their product? I've never gone into Target, bought me a sweater, and Target pays me for buying that sweater. But if you buy Target stock, they will pay you for having their stock. High yield savings accounts. If you go to mostly any bank that tells you, hey, you need a checking account and a savings account, you're looking at maybe 0.5% at best, maybe 0.25%. High yield savings accounts are paying out upwards of 3.5 all the way to 4 or even 5% of just holding your money. You did nothing different. You just held your money in a different place and you got paid to hold your money in a different place. And certificates of deposits, these are mostly given out by credit unions and banks. Just like you take out a loan, like, hey, I want to go buy a car, I want to go buy a house. Bank gives you a loan and you pay that back. Well, guess what? You can do the same thing to the bank. Hey, here's $1,000. Hold it for me. And you're going to pay me back plus interest. Again, it's your money. You did not pay more for it. You did not do nothing to it. You just held it a different way, but your money came back to you at 5, 7, even 8% if you do all these things together. First off with dividend stocks. Now, there's 2 routes, even 3 routes you can go with this, and both yield different results. You can get a dividend stock of a well-established Fortune 500 company, like I said, Walmart, Target, Apple. For example, me personally, I have $50 in Apple stocks, and every single month, Apple gives me 4 cents. Now, my $50 did not change. I didn't put more money into it. But every month I'm given 4 cents, which I reinvest into Apple because why not? I keep getting paid for it, so why not get more money for it? Now, the cons of having a big stocks is they are smaller dividends and it is less explosive growth. So you're not gonna get rich quick holding dividend stocks of the big companies, but you will never lose your money and your money will only grow and grow. Now, when it comes to these new startup stock companies, you're looking at probably 8, 10, 15% high dividend yields. Now, the thing is, these are new startups, so they're looking to grab your attention fast as long as the attention of investors. So you might be looking at Moderna. When Moderna came out, they were offering upwards of 17% of dividend yields, which looked great at the time. And those who bought in when COVID happened, you got your return on investment tenfold. But if you held Moderna after COVID was, let's say, cured, not really, you faced a steep decline afterwards when modern medicine caught up to the COVID vaccine. And that's just one of the risks of when you deal with a new startup company. Other things like dividend might get cut entirely. Moderna did that. They were losing so much money in their company, they just stopped giving out dividends. So now your money did not change. You still held the same amount of money in that company, but you do not get paid any more for holding that stock. Certificates of deposits, also known as CDs. So CDs, like I said, you have $500, $1,000 just sitting in your savings account. Go to your bank, say like, hey, I have this money, I want you to have it, and I want a CD. Most CDs are looking at about 3 to 7% yield. They're super safe. Your money is insured up to $250,000 by the government, FDIC insured banks. So you must go to an FDIC insured bank. Most of them are. It just takes a quick Google search to see which are not and which are. It's guaranteed interest. There's nothing saying, hey, you're only gonna get back what you put in. No, you're gonna get back what you put in plus something on top. Low interest rates, so the bigger the bank you go to, the higher yield you're losing out on. Plus, your money is locked. If you want that money, and let's say you had an emergency, you can get $1,000 back, you're paying a penalty. More than likely, that penalty you're paying is more than interest that you'd be getting out if you waited. So only lock in a CD if you know, hey, I can wait 6 months, I can wait a year, I can wait 18 months before I see this money again. Now, there's also something called a brokered CD. Brokered CDs have almost double the interest rates of these big banks that offer CDs. Now, and they follow the trend of the market, which can sometimes benefit you, sometimes hurt you. So it takes a more veteran approach to know what you're doing with your money before you take the approach of having a brokered CD. You can sell early if the interest rises and the bank is losing too much money paying you out if they wait. You don't pay an early sell fee. You just sell like, hey, interest rates climbing upwards to 8%. If you sell at 6.8 instead of waiting until 8%, we won't charge you. We'll still pay your interest, we'll still get your money back. Now, like I said, brokered CDs follow the rate of the market. So if interest rates are falling, you're getting your money back only. So you just lost out on 6 months, a year of holding that $500,000, but that's all you're gonna see from it. You're gonna see no benefit. Last but not least is your high yield savings account. Now, me personally, I have my high yield savings account and I only use that for 3 to 6 months of emergency funds. Meaning if you were to lose your job, medical expenses, you get hurt, you need to take care of somebody for a certain time, you can survive on 3 to 6 months of your bills. And what's good about having a high yield savings account, 3 to 6 months of your bills can be anywhere from $4,000 to upwards of $25,000. It's all according to your life expenses and your lifestyle. You hold that in a high yield savings account, let's say it pays out on average 3.5%. Your $25,000, you're getting interest paid every single month when the statement clears. 3% of upwards of, let's say, $5,000, you're looking at about $10, $15 every month just for holding your money in the high yield savings account. And then guess what? It keeps on maturing every single day, sometimes weekly, monthly, semi-annually, and annually. Now, what I recommend when you're shopping for high yield savings account, you want a high yield savings account that has no maintenance fees. So you're not paying for holding my money, you're just holding my money at your benefit, not mine. And you want a high yield savings account with no minimum deposits. You might not be in a place where you can have your 6 months of emergency funds saved up, but you can have something set aside and you can start earning interest immediately. Thank you.
Phyllis, and I am the financial center leader of Hancock Whitney Bank. Just to give you a little introduction, I've been in the business for banking for over 40 years, and I've worked with many of our competitor banks, and finally here with Hancock Whitney Bank. We do offer just about everything that you can think of. I do want to go ahead and add into what CJ have mentioned earlier. He gave a whole scope of products that it is offered in almost every credit unions and financial institutions. But specifically, I would like to speak more what Hancock Whitney has to offer. Hancock Whitney, we are a bank, a community bank, that we're native from New Orleans, and we're growing towards this direction and for the state of Florida very fast and rapidly. We do offer our best CD rates and savings accounts with high yield interest rates. We also offer checking accounts as well and money market. This is a whole bank that offers a very conservative bank that we have managed to allow ourselves to give more than others because we are a very steady bank. And so coming to our direction, if you ever be interested in how to grow your money, and whether if it's in CD, whether if it's in mutual funds or anything else, please do. We can sit down and we can discuss the many areas that we can assist you with money growth, as well as lending. I do have my senior banker, Melissa Bentley, that she deals strictly with our lending department and lending. Her focus is mainly for, personal loans to car loans to home equity. And we have a beautiful offer on a home equity starting for the first 6 months at a 4.99 interest rate only payment. And then it just develops to the 7.99 at that point. But it's a very good product. It's a startup for that many people will use for remodeling a home, to putting a pool in the backyard, to consolidate a lot of credit cards. Now that the credit cards, have gone up their interest rate to a whopping 16.5 to 30% in some cases, depending on the individual's credit. So we help and we sit down on trying to find an area where we can help you. And there's just keep in mind too, we like I said, this is a full service bank. We do offer business accounts, from merchant services to payroll to treasury to everything that you can think of. Business loans, we do SBA loans to help you grow your business as well. So if there's anything else that you have any questions on, please let us know. Melissa and I will be happy to help you and assist you on making that business grow, or making your financials, personal savings grow. And I do thank you. Thank you for coming.
Welcome. This is Carl Parnell with Hancock Whitney Mortgage. I'm here to discuss building wealth through residential real estate. Now, you may have heard in other presentations on this channel, my colleague JJ, who is a realtor extraordinaire here locally in our community, he can help you acquire the property. And I work for Hancock Whitney, and if you need information about possibly, you'll see in our presentation here, information about getting home equity loans or possibly bridge loans. And my colleagues Liza and Melissa here at the local #1 branch in Jacksonville for Hancock Whitney here in town that can assist you with getting those type of loans. What I do mainly is residential mortgage lending. So I'll help you get that temporary or permanent financing on real estate, residential real estate here. So what we're calling this one is building wealth through residential real estate. So the first step here is we're going to go to the slide, why real estate investing? And you'll see here, 80% of Americans believe real estate is essential to wealth. And if you talk to or read any people who have actually achieved great things in this country, real estate was a large part of portfolio. You'll hear terms of buy gold, buy stocks, those work well, but really a true safe harbor of value is real estate. Everyone needs a place to live, and they're only making so much land. So you know you're getting something that's a rare commodity, but it's one of the few commodities that can be used and increased in wealth. So just remember that the value of a home, real estate normally increases in value compared to other like stocks that go up and down, and even gold goes up and down. But real estate has really a great record over the last century of being nothing but straight up. We did have a dip during the Great Depression in the 30s and a little bit in the 08. But if you remember, some of you out there that had the crash of 08 or the Great Recession, as we like to call it, real estate has effectively gone up 40% from those low periods. So you've gone back to where we were prior to the downturn plus some. So real estate is still quite valuable. And in the Jacksonville community, we are growing so much. People are coming to our area needing housing, and that's keeping values up and keeping the interest in real estate growing. So keep an eye on that. You'll see the next line, a tangible asset you can see, touch. Most things that you invest in, such as putting your money in a CD at the bank, it's a statement that shows up. Same thing with your stocks, it shows up on a statement. But you get to use this asset every day of your life. So it's a great difference in having something tangible to work with. You can have multiple income streams where if you do buy investment property or rental homes, you can have both appreciation of value, where that home goes up in value from when you purchased it, and also receive rental income. So there's a couple of income streams you can get off of real estate that you do not get on other assets. Track record of appreciation. Again, like at the top of this I mentioned, real estate has a great record of continual appreciation through all types of markets. So what is appreciation? The property value increases over time. So I get this question a lot, well, appreciation, equity, what is that? Well, you bought a house 10 years ago for $150,000. It's now worth $300,000. That's appreciation, that extra money. Now, it's not money that you can tangibly hold on to, but you can tap into it with the help of a mortgage banker or a lender that can help you tap into that equity to use that to go for the next real estate. Or if you decide to sell that property, take that profit that you made, put it down on the next home. That's the most common way people use appreciation. They bought a home years ago, it's worth more than what they paid for it. They sell the house, pay off the mortgage that they have on it, use the profit to put down on the next house. So you'll see that rolling through people, many people their lifetime. They'll do that on average 3 to 5 times in their life buying a primary home, and that's how they're able to move up to the next one. It's getting that first one, which I can help you with as well. I work with a lot of first-time home buyers, and there's a lot of programs out there to help with that initial down payment and getting started. But once you get started, now you have an asset that you can start leveraging, is another term that's used, to be able to purchase other real estate. Cash flow, rental income. Now, there's a great thing, most people who are in investment lending, they don't have to pay those monthly payments traditionally out of their own personal income that they go to work and earn. They have a tenant that's paying that for them. And they pay the mortgage payment plus some. So if your mortgage payment is $1,000, but you're charging $1,500 in rent, that's $500 extra that you're earning off that asset. And by the way, that same asset that you're renting out is also appreciating in value at the same time. So that's the 2 income streams that you can get immediately. But you do use that extra money for repairs and maintenance and so forth. But it's definitely the way to go, to have someone else pay your mortgage. So if you're out there renting right now, just know more than likely you're paying your landlord's mortgage. So you really need to think about getting into the business of buying real estate yourself. Oops, went too fast. Cash flow, we talked about that. Equity, we talked about that, builds up ownership. So what if you have 4 or 5 different properties? Instead of building equity on one, you're building it on multiples. So suddenly your net worth starts getting bigger and bigger. And then last, tax benefits. I don't know why it's cut off here, but most of the time you can write off expenses on rental property and your primary residence as an expense, and it lowers your tax burden when it comes to tax time. Check with your tax preparers for that. I'm not a tax attorney or a CPA, but you do want to check with your tax professionals to help you with that. Appreciation. National home prices are up nationally on average 4.75 so far in 2025, or this time over 2024. 54% total appreciation since the first quarter of 2020. So we all remember when COVID occurred back in 2020 to usually about 2023, real estate went crazy. People wanted a place of their own to live. So we saw rapid appreciation, extreme great interest in owning real estate. So we were seeing people paying more than the asking price on real estate back at that time. So you will have, during the course of ownership, those peaks where your property appreciates due to outside circumstances, geopolitical or domestic issues like COVID that we had. It outpaces, most of the time the appreciation outpaces inflation. So it's a great hedge against inflation that you're investing in something that's going to be worth more year over year. Purchase. You see here an example, down payment. Purchased in 2020, 400,000, down payment 80,000, because most investment properties require 20% down. Now the value in 2025, the average home is up to 619,600. You've gained over 219,000 in equity. That's a 274% return on your original investment of 2020. So you can see right there in the numbers, this is national averages, how quickly you can gain wealth through real estate. The next thing is cash flow. It's most of the time it's passive. Every once in a while you'll have a repair that needs to be done, but most of the time your tenants send in a check. If you have a mortgage, you pay out of the rent check, you pay the mortgage, and you then invest the rest. So it's a great way to build it. Typically income increases with rent inflation. Now, if any of you out there are renting, you'll know that you usually get a notice once a year from your landlord that your rent's going to change. And the odds of it going down are almost zero. Most of the time it's going up. So that is what's happening out there in the marketplace. But if you own real estate, even though you can raise the rent, that mortgage, if the landlord got a fixed rate mortgage, that means that their costs are going up a little bit due to usually taxes or insurance, but not as much as what the landlord's able these days to increase rent, to increase their income. So that's another reason why if you're renting, you want to buy real estate. Stability of house payment. And then we got here equity building. It's a way to save money. So right now, as my colleague JJ and my colleague Liza said, that yes, you can put money into a bank, and it's a great way to have a safe haven for money. But that is only going to pay you so much. Here you get greater appreciation off real estate. So you want to start saving money, and you still want to continue when you're a landlord, because you will need emergency funds if something comes up on a home that needs to be repaired. But better to put money in real estate than just to stick it in a savings account if you have the ability. Tax benefits. So again, we talked earlier that you can write off many things on investment properties, such as repairs, taxes, interest, so forth on the mortgage, which will lower your expenses going out, so you don't pay as much money on the income you're receiving from the rental. So again, check with the IRS or your CPA or tax preparer. I'm not licensed to really direct those, but there's also a program out there many people don't know about. If you're purchasing real estate, but you want to sell that asset, that real estate asset, and not have to pay all the taxes on the appreciation, you can do something called a 1031 exchange. And 1031 is a IRS term where you're selling one property and reinvesting all that money into something equal to or more expensive than what you sold. And that's how you can avoid the capital gains taxes and so forth. And you can keep doing that and building, using the equity from your rental property, plow it into maybe a slightly more expensive home where you can charge more rent, and keep building that way. So you can either add more properties or increase the type of properties, the value and the rent that you charge if you change to a different type property. So that's something else to consider. Controlling assets with just 80,000. So if you buy a house with 20% down, it costs you 80,000 to buy the house, but the home is worth over 400,000. Instead of having to put into a savings account 400,000 to make interest off of it, you put money 20%, 80,000 into real estate, and suddenly now you've got an asset worth over 400,000 that's increasing in value and paying you more interest than you would in other instances. Appreciation applies fully to the property value, just not to your investment. So the appreciation is to the property, not based on what you paid for it, it's based on what the market will bear. So if you get a great deal on a property, that doesn't mean that 4.7 average we're seeing is going to be automatic. You can buy different properties and have different appreciation rates, some even more than 10% a year. and it's hard to find a return on asset that big. Low interest rates right now, we're fairly low. When I started in the business back in 1992, we were in double-digit interest rates. So it was quite different. We're now averaging in the 7s for investment, in the 5s for primary residences. So what you're looking at is rates are pretty much near the 40-year average. So we've seen highs and lows. When I first got into banking as working much like Liza and Melissa here at Hancock Whitney is working in the branch level, it was my job to post the CD rates and the mortgage interest rates. And I can still remember posting 17% for a mortgage. Now, of course, a home in Jacksonville at that time you could get for less than $50,000. So 17% on that smaller amount does not seem as great, but if you imagine 17% on a $600,000 house, we don't want to go back there. So right now we're complaining about the rates. They're really not that bad. And let's see. Average returns on real estate between 9.5% and 11.8%. It's a tangible asset. You can leverage it to buy other properties with by using the equity from it. And the stock market only averages about 8 to 10% returns on a good year. So really you're getting a better return in the real estate market. Inflation protection. Well, when you put money into savings and you're getting 2%, but inflation is 4%, that means you're losing 2% of every dollar. But that same inflation helps real estate by increasing its value. So it's a great hedge against inflation. Building generational wealth. Well, we hear that term, and there's a gap between people who think they can't get real estate, and it's not because they can't, it's just having the knowledge. And one of the parts of generational wealth is also generational knowledge. Somebody's got to start. And if you're that person that wants to start getting into real estate, you can affect all around you and change the direction of your family. You want to buy and hold for long term. You'll hear house flippers, and you'll see them on television where they go in, spend money, and turn around and sell it for great profit. That can work if you know what you're doing and how to do it, but for the average citizen, it's a little bit more complicated than it appears to be on HGTV. They're very entertaining, but they're not always accurate in real world. So it's better to buy something that you want to hold for long term. So most consumers hold their primary houses between 5 and 10 years now, but you want to hold real estate rentals just as long so you can get the most appreciation out of them. You can also do what they call multiple family. Now, multiple family is your duplexes, your triplexes, and your fourplexes. And you can actually buy say a fourplex, 4-unit place, all building attached, and live in one and buy it as a primary residence, rent out the other 3, and make enough income to help pay your mortgage payment because your fellow tenants, the other 3 units, are helping to pay. So it's really a great investment to get you started. Key takeaways. Real estate builds wealth through 5 powerful mechanisms. Historical returns outpace inflation or match or exceed stocks. You can leverage and you have tax benefits, and also creates both monthly income and long-term appreciation. So any questions on that, please reach out to me. Again, I'm Carl Parnell with Hancock Whitney Mortgage, and I can be reached at 904-476-5236, or my website, Carl, that's CarlParnell.com. And I look forward to helping you.